Okay, good afternoon. Can you guys hear me and see me? If you can hear me and see me, type yes in the chat box just to check whether any one of you can hear me and see me. If you can hear me and see me, just type a chat box. Yes at chat box. Okay, thank you, Scarlett. Okay, Charlotte and Ji Hong. Okay, good. Welcome to again once a month. We meet here to go on to talk about how to grow your money, how to grow your investment. Thank you for coming for this monthly mastery uh, accelerator program, the group coaching. Okay, let me share my screen first. Okay, can you guys see the screen and see me as well? If you can see me and also hear me, just again type okay or yup. All right, thank you. All right, good. Now you can see me and hear me. Okay, now on the screen, you notice, oh, this is part 2. Yes, this is part 2. Last month, we met and we spoke about the very important element of investment, that is share investing, right? And today is part 2. I just want to check maybe a show of hands or type a chat box if you have done the part 1. Just type a 1 at the chat box so I know that you guys have done or seen or have watched the part 1. Right, I just want to know how many of you have seen and watched the part 1 so that I will know whether it will be too fast or too slow for you to go in. All right, perhaps only one person has watched or came to the first part 1 program. Nevertheless, part 2 is a continuation. We go more in depth into what we discussed. Part 1 is mainly on talking about mindset, talking about why you need to invest, why you need to learn to invest in share. Right? I just want to set your mindset first. I am not telling you after today. Yes, part 1, yes, there is a recording. If you have missed that, let me know. If I missed out sending to you, let me know, right? I think I sent out to some of the absentees the last class. If you have not received the email with a link, let me know again later on. I will send you the link for you to watch the part. Right? Okay, so as I recap here, share investing is one very important element you need to know. Reason is, I think we spoke about a lot of vehicles in the past. Like example, we talk about bonds, talk about also unit trust funds, right? And you notice when come into unit trust or the funds, right? Be it ETF, a lot of these funds behind the scene is the fund manager investing into share. They are investing into share. So indirectly, you're investing into share, but you go through a third person, a third party, which is called the fund manager. Hence, you got to pay some fees called annual fund manager fees and whatnot. Sometimes it could be quite heavy, because it could be 1.5% or even more, depending on the funds that you're investing. Hence, I think it's important for all of us, once we are so, I will use the word used to investing and understand the market situation, the ups and downs, the fluctuations in terms of the share price, unit price. Now, maybe you want to learn how to invest more direct into specific share, specific counter. Reason is, in this case, you will save some money. The 1.52% annually is compounding annually in terms of your expenses. So you can gain the most. Of course, don't jump into it first. I want all of us to have concept. So part 1, we talk about the reason why we need to invest and the basic understanding about what is share all about. But today is more on practical. All right, so allow me to go in further. Okay, now part 2 is basically building your share, your investment portfolio, for passive income. I must stress the point. I think I told some of you during the last class, I am not here to talk about some gurus where you see advertisement in the internet. They tell you, oh, now you should do trading, make more money. No, I am not a trader. I'm not a trader. I'm not a speculator as well. That means I don't hear from people and then I invest. Right? Likely, I also don't sit in front of the monitor every day, buy, sell the trader to make money every day. my strategy is talking about how to invest and build a portfolio so that this portfolio will provide me passive income. Likely, I am an investor investing into dividend share. Dividend share is what I'm talking about. All right. So let's move on. What is this all about? Basically, there are 5 steps for you to build your share portfolio. We touch a lot on phase 1, the mindset last month. Yeah. So we talk a lot. Yeah. How you need to think like a banker. Let me recap. Yeah. First thing first, you are investing into specific company. People coming to you, hey, give me your money, invest in my company so we can grow the business. When we grow business, we make profit, we will distribute back you the profit in terms of dividend. All right. Now you hold money. You must think like a banker so that you don't simply give away your money, right? How? Now, if you ever go to the bank to ask for a loan, the bank manager asks you for a lot of documents, isn't it? They will talk about, okay, give me your IC to check whether you are the real person. Then give me, if you're working, the last 6 months pay or 3 months pay to check whether you have a valid, stable income. If you are a businessman, then they say, give me your 6-month bank account as well. Then your tax assessment, even sometimes your EPF. Then behind the scene, they'll go to the secrets, they'll go to CTOS to check what is your rating, what is your record, so that they will look at whether you are a credit-worthy or uncredit-worthy person, right? If uncredit-worthy, definitely your loan will be rejected. If you are credit-worthy, okay, they will give you the loan. So this is how the banker, the mindset of banker before granting you the loan. Now, people come to you, hey, maybe Lo, I know you got some money, okay, we are spending, I want you to invest into my company, aka into the share. You now got to act as a banker. How? I would suggest us to go through a similar process as well to actually, okay, before I put money into your company, give me your annual reports, give me your quarterly reports. Let me look at it first. Behind, I also check on the internet and whatnot to look at the press releases, any corporate announcement. I have to see whether any negative news regarding this particular company or not. Then from there, I need to look at 4 things. The 4 things that we have touched the last time. I will go into detail again. First, look at the business itself. What is this business all about? Second, the management of the company. Who is running this company? Third is the financials. A lot of numbers you have to look at. Then valuation. Today we talk about valuation. Then you have to put all this number into some formulas to look at, based on the evaluation or the valuation, whether it give me the kind of confidence to put my money or not. So there will be 3 scenarios here. Scenario 1 is fundamental is bad. Then when I do the evaluation, is also very bad. Thank you. Dismissal. Thank you. I'm not interested. This scenario 1. Now, scenario 2 is you look at a fundamental, very good company, right? Business everything solid. Just that the numbers are not there. Perhaps the profit is not really steady. Perhaps certain area not satisfying you. So maybe in this case, the evaluation part is not so good. Now, you keep it into a watch list. Perhaps not now. Perhaps once they turn around, perhaps they have new product launching to bring more revenues, then the numbers go back to normal. Then I will come back to them. So KIV first for scenario 2. Scenario 3 is for this company, you look at the fundamental very good. The evaluations also include whether it is worth to buy now. Is it too expensive or not too expensive? Definitely not too expensive means yes, buy now. Scenario 2 could be everything good, but it's slightly expensive now. So you keep in the watch list. All right. So I hope you understand. Scenario 2 and 3 are good companies. Sometimes due to the numbers, it could be too expensive now. It could be their profit not steady now. You keep in view. If everything okay, buy now, right? This is how you build your portfolio. That is actually our first step. Now, moving on. Step number 2 is talking about, it's talking about we need to look at the accounting side, right? Evaluate. You need to acquire the skills, as I mentioned just now. how to look at the numbers, how to evaluate. So we need to have some accounting skills here, or else we are not able to check whether this company is good. I want to present to you how actually using this 4 quadrant, yeah, BFMV. B stand for business, BMF is sorry, M stand for management quadrant, yeah. Then F is a financial, then V is actually the valuation. Let me go in one by one. Okay, business quadrant, right? Now, I want you to look at what is this company doing? What are they selling? What are they offering in terms of services? Is it a cash generating business, right? Do they have a large pool of customers? Example, if they are, let's say, if you know, what you call it, petroleum related company, so they supply to Petronas, the drilling equipment example. So they only got maybe 1 or 2 main customer in the world, Petronas, maybe some of this company only. So if they got the tender gone through, then they have the case, they have the sales. If they fail in the tender, they will have no sales. So this is like serving a few customer. Versus example, some company are selling, let's say, telecommunications. Oh, they have how many millions of subscriber or user, right? So even they lost 1 or 2, it's okay because they have a large pool of customers. So you need to prefer the company with large pool of customers, so that if any changes, any more aggressive competition, they still can survive because they lose couple of customers, they still got the balance of millions, right? Example. So this is one thing. Then growing customer base. Is this product considered sunset? That means no longer able to upsell, cross-sell, and increase, or they just maintain? Or actually they can really sell more because perhaps now only 20% market share. They can always stretch that. Example. Recurring income. Whether the business model, whatever they do, is on the recurring basis. Example, as I mentioned, telco. People sign up for the plan likely every month, right? I will have my credit card, sign on. So every month they will just charge to my card, so I don't have to be forgotten about paying my phone bills. So this is like recurring every month continuously. This is a model we should look at versus they only sell one off, right? Then no repeat buying, right? Then of course whether this brand is a widely recognized brand or not. If you know this brand, that means it could be more people know this brand as well. So this kind of business is more, I would say, in terms of us choosing, this will be the more preferred one, right? So B, anyone got any question that need my clarification? The selection criteria of this company. Quite straightforward, right? So I think you should know. Later we'll test. I'll throw you 1 or 2 names. See whether you have heard of these names before, right? Now, this is the B. First thing first. Now, let's move on. Next is, we move into, the next is M. M means management. It is slightly tricky. You have to really go into the annual reports to look at who are these people running the company, the management team. On the other hand, maybe we might not know all these people, but you may be able to sometime Google and find some of the names. Good one, never mind. If not so good one, then you got to be careful. So you have to see whether these are the honest people. Imagine if a company where the shareholder is actually involved in money laundering, now is having a court case. Example, do you want to invest in this kind of company owned by these kind of people? I think about half a year ago, it happened whereby 3 of the directors of one company gotten into the investigation, some anti-money laundering cases. But somehow or other, these people not only own one company, they have owned multiple companies as well, all listed. So example, if you have these kind of people, of course they are not guilty, they're still under the trial, so I cannot say they are wrong, right or wrong. So if they are suspected to be breaching the anti-money laundering, that means they might not be honest people, so you might not want to choose this kind of company to invest in. But anyway, this company that I mentioned, owned by these directors, the share price plunge, and one got to be delisted as well. So what I want to say is be careful, because once things goes wrong, then your money also go nowhere, right? So check whether they have proven track record. Again, whether they themselves are having a skin in the game. Do they own certain capital. Example, they own 5%, 10%, 20%, 40%, right? So that they own certain percentage of shares into that company. So their money is inside there as well. They have a stake in the business. Hence, this kind of management likely will treat this as their own company. They will use the company money as per their own money. So they likely will be more thrift, more careful, right? So that is something that you need to look out for. And last but not least, you have to recheck whether they have any frequent change in terms of the company names, right? Change of directors, sometimes even change of company names too often. It might not be a good sign. Reason is maybe the old name, the certain people are not so good, so they have to do a rebranding example or change your image. So second quadrant is the M, right? Watch out on this, whether these are the good people that you can work with, put your money to the company. Now come to the next one is F. F is financial. This you can obtain the information from their annual report, quarterly report. You can look at their revenues. They sometimes put a 5 years past record, so you know the revenues of past 5 years. Likewise, also their net profit. Very important. Yes, they have revenue, sales very good, right? Then next is whether got profit or not. Okay, profit also very good, but you have to look at the third thing. How about their operating cash flow? Some of this company, they have good sales. They may look like they have net profit, but at the end, the free cash flow, the operating cash flow is very, very small or sometimes negative. Then you got to be careful. That means they may pay off certain debts, pay to shareholders and whatnot, but at the end, they are operating in a very thin line. Maybe they don't have enough cash. They keep borrowing to fund the operation. So you got to be careful, right? Cash flow. Then short-term liquidity, how is the money goes, and then long-term gearing. Do they owe a lot of money, right? What is the debt ratio? So this is something that you need to watch out. You need to find a company that is solid. If not, then who knows? They give you just jump a bit first. Some of the company give you good dividend, so they attract you to buy their share. In fact, they attract your money into the company so that they can have more cash flow and whatnot, right? So this is something that you may be careful. All right. Now, the fourth is revaluation. This is where today we will go into some formulas. At least you have some brief understanding. What do we mean by valuation? I display here three things you need to know. First thing called dividend yield. Second is called earning per share, EPS. Third is price to earning ratio, the PE ratio. Right, I'll go into that one by one. When you invest in share, you have to look at these three, minimum these three, I would say, indicators, right? And from there, you're able to look at whether it is good or not. Right, let's go on. Now, dividend yield. Why is it important? I just look at this particular example here based on 2023 Maybank's annual report. The annual dividend, they declare 60 cents. So what is this 60 cents is about? If I buy the share, then look at how much you are buying. If the share price at that moment when they declare is 8 ringgit 95.52 cent, 0.9552. So you use 60 divided by this 8.9552 is 6.7%. That means they declare 60 cent dividend, your dividend yield is 6.7%. Anyone can tell me 6.7% good or no good? 6.7% good or no good? Okay, no question mark, it's good lah. Very simple. You compare to FD. FD maximum is around 3%, isn't it? Right? Then if you put into bank, it was 2.70%. Of course, if you put into EPF, it's only 5.25 lately, right? When they declare. So 6.7 is definitely, I will use the word much better, double than putting in FD, and even I will use the word maybe 10-20% higher than the EPF declaration, right? So it's a very good, I would say, return. Now, that's why the first thing you have to see is when I invest into this X share, what is the dividend yield first? If it give you 2%, you want to invest or not? Yes and no lah, but likely no lah. Why? You keep the money in FD lah. Give you about 2 point something, 3% better lah. Save all the hassle some more, right? Isn't it? So that's why dividend yield is the first thing you have to see. Of course, it is not the only one, and you cannot be too aggressive. I don't use the word greedy. Don't be too aggressive. Or then like that, I just look for the one with the highest dividend. Or maybe those give me 8%, 9%, 10%. I invest there. No. Hold your horses. You have to look at the other indicators as well, right? So first thing first, dividend yield is for you to see, hey, worth for me to put my investment here or not, compared to what example most of you the FD fans, I use the word. So maybe it's compared to FD. I look at 6.7. Yeah, I think is better. Yes, can consider. Let's look at the second one. The second one called EPS, earnings per share ratio. So of course, I want to save all the hassle. Basically, you can find this easily in internet. When you download the Maybank share, they calculate. Oh, actually, 77.6 cents is my earnings per share. That means one share give you how much of return. EPS is very important. Yeah, simply put, is how much of their net income once they minus all the thing become the net profit. The net profit minus the preference share dividend. The rest they will distribute to all the common shareholder. So this is how you gotten your earnings per share. Oh, it's about 77.6 cents per share. Why you need to know this is because the next ratio, PE, price to earning, it is very important as well. Beside the dividend yield, these two are very important. Dividend yield means, just now we talked about the price of Maybank as of December 31st, 2023 was 8.9552 ringgit. And then just now we also gotten the number EPS is 77.6 cents. So it give me this ratio called 11.5. What is this 11.5 price to earning? That is, in order to earn the 77.6 cents, how much you need to put in? You got to put in 11.5 times of the money. I repeat, in order to earn 77.6 cents, how much money I have to put in? You have to put in 11.5 times of that money. Alright? Reason is there is a benchmark. Is 11.5 high or low? 11.5 is high or low? Now, later I'll share with you that in Malaysia, I will go for anything that give me lesser than 25 times. US maybe 25 to 30 times. That is the benchmark. Don't go for anything that's too high. That means you got to put up a lot of capital to earn that particular dividend, to earn that kind of dividend. So keep this below 25, 30. That will be the safe zone that you are investing, right? PE ratio. Whatever I mentioned here, don't look at a single year. You have to look at maybe 10 years. What will be the different PE for different year for the past 10 years? From there, you are able to judge whether this 11.5 for Maybank in this case, is it high or low or just within that, right? So this is what we need to discuss later on, right? So far, 3 ratio, dividend yield, the EPS, and the PE, right? Remember these 3 things. So far, okay? So far, okay? I just want to make sure I am not going too deep. Also, I make sure I give you enough information. All right, I think it's quite straightforward, right? For those of you, maybe you learned econs before, maybe some of you have learned some of this terminology before, right? Good to have a recap. Of course, you asked me where to get the Maybank one. As I mentioned, I download their 2023 annual reports, and from there, actually the first few pages, they already show all the numbers. You just plug from there. It's good enough. Do you want me to show you the sample of the Maybank annual report, and from there you can read? I think it's page 3 or something like that. It's just in front. They just give you this because all the investors know that they need to look at all these three important items. So it's all there, right? So in this case, I will not share with you the Maybank thing, right? So on all, look at your share investment into this BMFV, this four quadrant, to see whether they fulfill your criteria. If yes, then you can consider, right? Before I move on, I need to bring to your attention that always, whether you invest in anything, likewise here, invest in dividend growth share, there's also risk associated. I need to tell you, because there's nothing guaranteed in the world, right? That the stock price will not fall, the dividend also will not fall, right? So nothing is guaranteed. Stock price may go up, may go down, dividend may be high, may be low. Nobody can predict, right? So and some more, if you gotten your dividend, you go and buy again, top up again, reinvest again into buy more units. If the market go down, of course you suffer more because it amplifies more, right? Because you put more money into it and then it go down, right? Of course, another thing you need to know that is that what I share with you is not a make money get rich quick scheme. It's not that a get rich quick kind of investment. Sorry, I cannot tell you follow buy Maybank. Just example only, don't buy, example only. So don't go and buy and then tomorrow you make millions. No such thing. Dividend growth for long term. Because you need to buy when the dividend issued to you, you reinvest back. Is how you actually grow your portfolio. Is how you actually I will use the word accumulate and also compound in terms of investment, right? Because you have to put the money back, the dividend back, to buy more, right? So one thing for sure, nothing is guaranteed. You need to understand that. Now, next, if you really have followed me last month and now, maybe now you think, yeah, I think look makes sense. Is what you say. Not only we have to invest in unit trust, we have some bond, we have some ETF, we have some cash with FD. Maybe the rest of money we should have more exposure directly into the equity market, the share market. Then I want to go in. But how to go in? Normally, stage 3 or phase 3, we talk about prototyping. Prototyping means you are now looking at setting up, maybe I want to select few stocks only. Here, I will suggest 1 to 5 stocks to begin with and allocate maybe 10 to 25,000 ringgit Malaysia. Yeah, contain the investment into just a small one. Maybe use a 10,000, buy just 3 stocks, 4 stocks, or 5 maximum. Or you may not do anything, but you construct a virtual one, or that means you use Excel, and then you just assume you buy, and you just play with the Excel table and monitor 1 year later whether with whatever you ideally practice can make money. Then once you feel more comfortable, only then you go into buy the share real, right? So it could be on the virtual practice, it could be limit yourself to 10k exposure, investing in just a handful of the stocks, right? Now, how to begin with, right? So I want you guys to build a watch list. They mean buying 1 to 5 doesn't mean you only see 1 to 5. You see more than that. You perhaps look at 20 to 30 good fundamentally strong stocks, and then from there only you select the few you feel more comfortable with, maybe 1 to 5, maximum 5 to 10 stocks. So just buying a little bit. Do you know that nowadays we can buy stock as small as 100 units? Do you guys know? Yes? Anyone know about that? 100? No, okay. Those days, long time ago, when you buy a share, it must be one lot, means 1,000 units. So just now, Maybank 8.9552 times 1,000 is 8,955 ringgit and 20 cents. That means one lot of Maybank share is almost like 9,000 ringgit. You feel scared or not? Definitely feel scared, right? So those days when people buy share, it's like almost like, example 1 month, 2 months of my gaji. Sometimes it's like 1 or 2 months, or even few months of my saving. How can I just put into one? So dangerous, so risky. Now they chop it smaller. You can buy 100 unit. Example, if just assume Maybank is the one that you want to invest, maybe just buy 100 unit. So it becomes 899 ringgit or 900 ringgit lah. So you now can invest into a few different types of share just to learn, right? So that's why I said you can build a watch list and then just buy 1 to 5 or maximum up to 10, right? And try to do it slowly. No, don't rush slowly. And yeah, take about a year time or less than a year time to build your profile. Now you may say, oh yeah, sounds good. How to do it? Now I think it's 100 unit, quite small lah. 800, 900 ringgit, Maybank is considered one of the highest already. 8 ringgit something. You can go for those 4 ringgit, 2 ringgit, right? So it could be more, right? You can play with more affordable, good stocks. So how? Now I just want to give you the next is actually not from me. This is from the book I recommended to some of our friends who we have the personal coaching. This Casey Chong, he has this particular series of books, but this particular one called the Complete Value Investing Guide. He listed his matrix, screening matrix on choosing good dividend share or dividend stocks. He said, okay, there are 10 things we need to make sure we must have before I consider this as my watch list. Market capital, the particular company, the size must be at least more than 300 million kind of market capital. Revenue a year must be about more than 100 million a year. Of course, the yield 3%. As I said, if less than 3, what for you do? You put your money into bank or bank FD lah. So at least it must be bigger than bank FD, only worth our consideration. So that's why that is the dividend yield 3%. Item 3. Item 4 is, yes, the dividend must be about 3, but must be also consistent and preferable growing, year by year. Then number 5, you must also make sure this company, they have growth in revenue and profit. 2 things. Revenue means sales. Some company got good sales, no profit. So you must look at both. They have good growth in sales, the revenue, and also the net profit. Now, item 6, what is payout ratio less than 100%? When they make profit, how much are they paying back to the shareholder? Here, we prefer them to pay out up to 100%. That means if they make, let's say 100 million, they redistribute back 100 million back to the shareholder. Maximum 100%. That is the profit. They cannot do more than that, because when they do more than that, they mean they are taking some other money inside the company to distribute out, which is not from the business itself. It could be they sell off one piece of land, then that year they have a great money, a chunk of money, so they use the money to pay back to all the shareholder. It's good for us as shareholder, but if we have not bought the share, then you look at it, wow, dividend very good, 8%, then everything looks good. Then you look at the payout, oh, it's more than 100%. That means they are using some other money somewhere to fund this payout. That is not good. Item 6. Item 7, as I mentioned, free cash flow. They must have, after that, still got cash flow to run their business, not like taking loans to run their, borrowing money to run the business. So you got to be careful. Make sure they have more than 0 they got cash flow. Then return on equity is more than 8%. If not, then no other, then I think we would consider it. Then number 9, debt to equity ratio. How much of money they are asking? Like they are offering share, right? Basically, they also take loans from bank, whatnot. So you need to see whether how heavy is the debt. If heavy debt, then it's dangerous. So make sure it's less than 1. Last is the P ratio. We discussed just now. 11.5 is Maybank, right? So we shouldn't go for anything that is more than 25%, 25 in Malaysia, right? So this is something. Now you may ask me, oh yeah, this 10 very good, but how to do this 10? What is it all about? How can we do it? Okay, let me share with you something. Hang on a second. All right, let me go and share with you this screen. Okay, see whether you can see this or not. Hold on a second. Okay, can you guys see this particular screen, which I can enlarge it? Are you able to see something called a stock screener? If you can see, put a 1 for me so I know you guys can see this. Type a 1 for me if you can really see this particular screen, the stock screener. Yes, can see. All right. You can just simply type KLSE screen KLSE screener.com. Right, you can easily go to this particular free tools for you to actually use to help you screen what is in KLSE. This is particular for our Malaysia stock market, KLSE. So I hope you guys can see this. So just now we talk about the particular item. Okay, now let me do half here. Market cap. So if you can read here, main market Malaysia. Then market cap more than 300 million. So in this case, I will look for this side. I will go down. Market cap, you can see my mouse. Can you see my mouse hovering there? I just want to see whether I can put a pointer, laser pointer or not to assist you to see this. Let me see. All right, so maybe I have to do something that is, hold on, let me do this again. All right, so market cap 300 million. So I type in here 300 million at bottom here. If you can see this particular highlighted one here. Revenue 100 million. So I also find this is something that very important. Revenue 100 million. So I will look at the revenue. Of course, here they ask me to check. Okay, continuously years, I put 10 years, must have profit. Then net profit, I just let it done here, this area, right? So this is how I set the particular area. The profit for 10 years, consistent. Item 3, dividend yield must be 3%. So from here, I type in 3 dividend yield, this area, right? If you can see here. So I just key in basically whatever thing listed here. P ratio 25. So I also put here maybe 25 example. So I just key in here 25. So I key in the 10 items here, right? I make sure they have net cash. The debts to equity also not more than 1, maximum 1. Then from there, I just press the button screen. Within 1 second, they are able to give me a particular set of 37 stocks. If you notice here, 37 stocks identified. Oh, these are the 37 in Bursa Malaysia that satisfied my requirement. So I go to the dividend yield, and then from there I just make a top down and look at, okay, if based on the dividend, if you notice here, dividend, the highest give me 16% all the way to 3 because I set myself minimum is 3%. So you notice, right, this column, the darkened area. So, oh, what is this company? Dime.com is time communication, telecommunication. Then we have Taan is plantation. Apollo. Anyone have this snack before? Apollo. Anyone? Yes, no? Anyone remember the Apollo snack? I grew up with this. I'm not sure about you. Anyone? If you know Apollo, type Apollo. At least just go through and see whether you know some of the names here. Okay, thank you. At least we are same era. Okay, then this is automotive, HL industry, Honda industry. Then we have B Auto, some pharmaceutical company, Amway, FPI. I'm not sure some of the names whether you know or not. Power Root example is the Power Root Tongkat Ali drinks, very famous among the Malay market example. So you'll be able to look at all this. There are some insurance company here, right? So all in all, 37 being highlighted here. So I just want to go back to show you after I've done this. After I've done this, all right. So now I hope you can see this. So this is how I build my portfolio. Okay, I show you another file. I actually download that particular file. Hold on a second, let me share with you the screen. Okay, all right, you can see an Excel table, right? If you can see Excel table, just type Excel. So at least I just want you to know. So just now, all the name we mentioned is all listed down here in green, the top 10, then blue, the next 10. This is how I open up a file to look at. I import some of the data we look at, okay, and see whether these are the company that worth buying. Of course, you may choose the one that you think you like, and you may choose the one that you think you are more confident with, and also the price, because you can only buy maybe 1 to 5 based on 10,000 ringgit kind of capital example. So you pick and choose which are the ones that with 10,000 ringgit I can afford to buy, because you look at here the price 5 ringgit, 7 ringgit, 4 ringgit, 2 ringgit, 1 ringgit plus. So some are expensive, 10 ringgit example. So you may look at the combination of your file, and then from there pick the ones that you think, yeah, if I buy just 4 or 5 with 100 units, 200 or 500 or even 1000, yeah, depend on your budget. So how you construct that is where I started my game, okay. And of course I've been tracking how much I am able to make. Of course, there's also another thing to look at is the PE. I also managed to find some of the company, what is their average PE for the past 10 years, what is the lowest example. So I know, okay, if I want to buy, average is 9, low is 8. If now offer me 8.66, I think I can buy lah, example, because it's average lower than average. If the one is currently average is 24, then the current is 29 point something, maybe it's too expensive, so I don't buy. The one in red are the one that I think is more expensive, so I will not consider. So this is how I play with this chart to do it, right? I hope you have an idea how basically we can use the knowledge online and construct our portfolio. You just start with buying one. Of course, before buying one, you got to open an account. Do you know what account you're going to buy? It's a stock brokerage account. You may use the conventional bank, like Maybank, Public Bank, all the banks, they all do that, right? Preferable link to your own bank account. So you can transfer the money from the saving into that share account for you to do direct purchase. Or now you have the apps like Moomoo and whatnot. So these are the apps also allows you to transfer money into the apps, and from the apps act as this particular brokerage for you to book the price, book the share, and then purchase. So this is what I want you to know, right? I just pause here for a while. Anyone here actually have experience doing share investment already? Anyone here? Anyone started doing anything? Yes. Okay, good. Apps or bank? Oh, many of you know this, right? Okay, good. Okay. May I know, are you doing what I do, or you have a different way? Same or different way? Or similar? Or totally different? Okay, buy and keep some, yeah. So what I want you to know is, if what I shared just now, you have to look at the PE ratio. PE will determine whether it is cheap enough to buy, because if current PE is higher than the average, you may buy it more expensive. All right, so that is one thing you share is very interesting. Never the perfect timing. Nobody can buy at the cheapest, just that you bought when you buy lah. You just bought and when you buy lah. So yeah, good to focus on dividend stocks. Okay, look at the dividend yield. Make sure the dividend yield is more than FD at certain rate. Then of course, don't always go for the company that give you the highest dividend. It could be very dangerous. You have to check at the business, check at their finances to do some evaluation, right? So I am a bit kiasu, so I make sure I gotten some of their information. From there, I will know, is it cheap enough to buy, still consider undervalue. So if yes, then I can buy. If sometimes it's oversubscribed, overvalued, then I will not go in. I'll wait for it to come down. So I always want to buy for a cheaper rate, right? So there's something that you may want to consider. Now back to our fundamental. Cheaper means what? Sure, something go wrong, only then cheaper, isn't it? That means if market is so good, if everything goes smoothly, definitely the particular share price will go higher and higher. Whenever there is a adjustment, likely come due to some issue, like 2 years back because of the US banking that having some problem. That's why people are so scared. There were about three banks wind up in US. Hence, Malaysian bank, the share price also dropped a lot. Yeah, but basically, I look at these are the good banks like Maybank, Public Bank, RHB. These are good banks, right? Nothing goes wrong here, but people just scared and withdraw. So the share price go down. So from there, I come in to buy, right? So now because of interest rate is so strong, dividend also so strong, people now like to pick up bank stocks. So maybe bank stock are picking up already, maybe not so affordable anymore. So if you buy now, you may be buying at a more expensive rate. This is what I would say. So this is something that I may want to just let you know whether yeah, it's a good time or bad time. So like Maybank, maybe now the price is already above the average. So if you want to buy, it's okay, but you are buying at slightly more expensive. I use the word, right? So this is something that I want to just bring to your attention. Why I monitor the PE, because PE is important, right? So this is something, but likewise, whatever you see just now, some of it are very good dividend share. So yeah, continue. Now, after you buy this whatever account, right? I want you to understand the share price will go up, will go down as well. So what will you do? Are you panicky? My answer is shouldn't, right? Shouldn't. How? Now I want to introduce to you on the left hand side, 4 very important things: fundamental, valuation, capital, and weightage. All right, what is it? Fundamental is the fundamental of that company, the share that you are holding. So when you notice, example, the share price fell, right? So you may want to go and examine, hey, what happened? This share that I bought went down. Check the fundamental business, right? Anything goes wrong or not? It could be due to example, they lost certain dealership, they lost certain main accounts, they lost even certain technology, then this company is no longer able to perform. Then if you hold a share for this company, do you think it will go up or is getting worse and worse and worse? One or two? I repeat, example, maybe 40 years ago, 50 years ago, you hold a Codex firm kind of share, which give you very good dividend. But after people invented the digital camera, then they are getting lesser market share. And you notice, oh, it's falling the share price. So when you analyze, fundamental, no more there, right? Do you want to hold continuously the share or you want to let go? Which one? Hold or let go? Let go, right? I think let go. So that's why the answer here, the decision is sell. If the fundamental of the company is no longer there, don't hold. One statement by someone I can't remember is actually we are not we shouldn't have any emotion, any connection with the share that we are buying. They are not our friends. They are not our relatives. They are not our lover, right? If you think the fundamental is no longer there, let go, sell. Right? So this first thing I need you to know, you have to keep on examine the share that you're holding. Once you notice the share price especially fall, then fundamental, they're not. If no, the rest no meaning. Don't have to look at the valuation, the capital or whatever. Go on to just sell. Scenario 2, you check actually, the fundamentals still there. Example, during COVID, most of the companies suffer losses. The share price fell, right? Most of the company. So you look at it, fundamentals still the same. They are still the same company, still making the items that people like, but somehow rather because of the lockdown, whatever, things just not moving. So that's why their revenue fell, right? So when you do the valuation very bad law, sales and revenue drop, net profit drop, all the ratio all drop. Okay, now you know fundamental good, the valuation shows no good. Capital means whether you yourself got money or not. The weightage means how much you're holding. Don't have to talk about whether you got money. Don't have to talk about weightage of this particular share. No meaning one, right? Now you have a choice here, to hold or to sell, right? Because some company, they just can't recover after COVID, example, or take many years to recover. Maybe it's good to cut loss to sell first. Or you think this product is highly sought after, so you can keep it, just hold. Okay, so fundamental is there, valuation no, then you can decide sell or hold. Next is, now you check this company, wow, very good, fundamental very good, valuation also very good. Wow, the market, the share price go up. But the problem is capital. That's you. I don't have the capital. Do I want to buy or just hold on first? Buy how? Ask money from friends or ask money from bank or take loan to buy share or, because I think it will go up one. Can take the risk. Yes or no? Yes or no? I'm a bit conservative. I will use the word no. No. Even though you think wow, the fundamental very good, valuation very good, sure, the price is going up already. Never mind. I take loan 4% or personal loan, maybe whatever, credit card 1.5% per month. 2 months down the road, I can make back one. No, please no. If I have no capital, don't go in. Hold on to your decision. Hold on to your decision. All right. So this is very important understanding. Now, scenario 4, fundamental very good, share price go up. You have the money. But when you look at just now the portfolio, I have let's say I bought 10 shares. I bought 5 shares, and happen this company I'm holding 25%. If I got 100,000 in investment, this A share I have 25k ringgit Malaysia into this share. So the answer is you shouldn't go in anymore, because this one company, the portfolio, the weightage is already more than 20% of the total portfolio. The decision here is you should hold. Even though it's very good, should go up, the answer is don't buy anymore. Why? Anyone can tell me why? Why don't buy anymore? Go up already, what? I got money, what? Why? Anyone can tell me based on your guess? I got money. The share is also very good. Just why? Why say don't buy? It's afternoon. You all can't think already, right? Everything's so good. Go in lah. Why don't buy? Why hold? No, it's not too big to be true. It's actually diversification. We learn this terminology, diversification. That means spread your money into different accounts, different types of investment, different counters, different market, different company. So if you put like, I like Maybank so much, maybe I will have more for Maybank. Example. The answer is we shouldn't have our portfolio more than 20% into one vehicle, one type of one company, right? Because in this case, you will not be able to practice diversification, spread your risk into different area, all right? I know because banking now is very good. Who knows? Who knows down the road? Yeah, who knows down the road? This share is showing yes and no, yes and no. It's not the dividend. It's how much you are buying, right? So again, you need to spread. Um, use Maybank as an example. Yeah, Maybank is the top bank in Malaysia, the largest. Their businesses also not in Malaysia. I think their business in Singapore and also other countries as well. But Maybank is still considered very small compared to other global bank. Do you agree? Compared to other bank, it's still very small because they only operate largely in Malaysia. And now with the what you call it, virtual banking, yeah, so many new licenses already approved, the e-banking thingy. Then also there are other bank in other country which is stronger, much stronger. Only their presence in Malaysia is small only. So Maybank could be good but not the best. So you just maintain as 20%. You may have example, some of your money invest in example. If bank in Malaysia, why not invest in bank in Singapore? DBS, UOB, OCBC, example. So these are also same category, right? Banking, but they operate in a different geographical area. Their return is also not bad, right? So that's why I say if you focus too much on one counter, you may lose out on other area, right? So yeah, scenario 4 is to tell you that we have to be a bit logical, just not to put too much money into one particular counter or vehicle. All right, so there's something that I would like you to know. Right, of course, number 5 is yes, this counter is very good, this share is very good, and you hold not more than 20%, then you can buy lah. You can buy more to make sure it is around 20%. Right, so that is what I want all of us here to have this kind of logic, spread your investment. Diversification is the word. So I hope you know how to optimize your portfolio, right? Because you may want to consider the money going to other sector. Example, when we talk about bank, maybe you move into other thing, right? It could be other sector that is equally good, right? So why not? Okay, so that is the sharing for this particular area. Now, after you already started your prototype, you already built and learned it for a few years. What do you do after that? The last phase is expansion. Now, I myself likely is in between the stage. Here got 3 scenarios lah. I myself is just somewhere in between here, crossing over. So to me, that's why I would tell you that yeah, after you build your stocks portfolio for Malaysia, maybe 2-3 industry, 5 industry, there's Malaysia. Then maybe you need to consider the next dollar after 25K is into other countries. Maybe begin with Singapore. Malaysia and Singapore, first thing first, is very close. We know or we get to know easily some of the information there. Some of the companies, maybe if you don't know, you can easily ask someone, hey, what is this, what is that, right? So you can easily cross to Singapore, which is nearer, and we enjoy very similar kind of tax in terms of investment. There's dividend is not taxable, so you can always bring back. And of course, this is not the thing we should tell, but I just tell, yeah, who knows, Sing dollar also will appreciate after some more and more. Who knows? I hope not so much. Then you can bring back more money if you invest there, right? So first thing first is you may want to expand to Singapore, right? Singapore also got a couple of the sectors doing very well, yeah. So it could be, yeah, next move is beyond that, beyond 25K to 100K, it could be to Singapore. After 100K, then you should consider move to include like Hong Kong and US, yeah. Malaysia, Singapore, and Hong Kong in the part 1 I mentioned. All these 3 I do say countries. Hong Kong is not a country. All these 3 locations, basically, dividend share, the treatment of the dividend, there is no tax. But for US, the dividend that they declare is subject to 30% of withholding tax. So you will likely get lesser money if you invest in a US based dividend share. So perhaps the US, then you are looking into a mixture of some growth stocks as well. Okay, so that is the way moving forward. Expand yourself from a 10,000 to a 25K. That is for the scenario in Malaysia. Beyond 25K to 100K, then you include the Singapore. After you have experienced enough in these two countries, then you can invest your future money into further Hong Kong and US. Right? So I hope you understand what I want to share for today. Basically, to tell you that, yeah, this is how the route for you to move on. That is on scaling and diversification, diversifying your portfolio. Whatever we mentioned just now, diversification continues to be a very important part. Malaysia is a very good investment destiny, but again, our growth is not as rosy as our neighboring country. That's why we need to expand the horizon into Singapore, perhaps into Hong Kong and US. Right? So that is something that I want to let all of us know. The fund that you buy, the fund manager also likely do the same strategy. Right? So you need to also learn from that. Okay. Now, one thing I want you to know as well is actually how to protect your portfolio. If you only got the Malaysia portfolio, of course, by having a view, you can easily pass the particular asset into your, park it to someone later on when they are no longer here. But when you invest in Singapore, Hong Kong, and US, you need to understand how it works. I briefly tell you, if you have a Malaysian will that is a valid one, you need to reseal your will in the few foreign countries that you have assets with, right? So you need to have that one Malaysian will, reseal it again, because to use it again, the same will in other country, there's a terminology called reseal. Go to court to reseal it. So the same will, same content can be applicable in Singapore, in Hong Kong, in US, example. But should your portfolio is really that huge and substantial, more than half a million ringgit Malaysia, do consider having a separate will individually for each of the maybe brokerage account or asset in that country. Example, one US will, one Hong Kong will, one Singapore will, one Malaysia will, example. So it's easier because it takes times for you to seal or reseal the will. You've done the Malaysia one, only then you use that, apply to Singapore. After you've done that, only use that to apply to Hong Kong. Then after that, only apply again to US. If each takes you about half a year, maybe you need 2 years to get everything done, right? That's why having a standalone will would be a better situation to deal with this, right? Of course, I am not a professional in terms of the legal aspect. You may want to engage, if you have asset in US, maybe a US lawyer to help you in Hong Kong, in Singapore, or even Malaysia, right? So that will be something that I will share with you for this particular month, yeah, investing into share. To recap, use the screener, the stock screener, to actually help you screen. I will use the word stocks that actually with comply the requirements that we listed, the 10 items just now. Then from there you pick which one you want to choose. Right, that actually can save you a lot of time to do your study. All right, I'll just pause here for a while. Anyone got any questions that you want to ask? Then you may want to ask me. I can just pause here for a while. Okay, anyone got any questions? You can type in the chat box. In case you don't know what is that particular screener, I can let you know. You can just use this particular link. I will copy over, so you may want to go and play with it, right? So this is the www.klscscreener.com/v2. So that is what I'm using. You can also use this, it's free. to go and play with this particular screener, and from there choose that. The Excel file that is for myself. I can't give you all. I can give you the half, which is actually the direct what you call that download from the KLSC screener, because they can export from there. Of course, you have to play with the row. Then I just make the sequence according to what I see. I can share with a sample. I use the word as sample, and whatever I did was actually that one done end of March. So it's not the recent one. I must tell you, it's not a recent one, because you may want to do every now and then to look at it, right? And I must tell you, I am not suggesting you any counter. I'm not. So it's up to your own decision to buy which stock. The sample show is just a mere sample, because I think that bank is considered a famous bank. People all know about that, so I use that bank as a sample. You need to study the stock price so that you don't buy too expensive, right? So make sure the PE is within the 10 years average. At least you buy in a cheaper or average price. Yes. June, anything? Because I saw you switch on the mic.
Oh no, accidentally pressed sorry.
Okay, sure.
But I have a question.
Yep.
What is your advice if we were exposed to this term called foreign market share investment? Is there any advice like how to start and where should we start with?
Okay. The process should be very similar. First thing first, foreign market share. That means buying in foreign country. Is it buying directly into foreign country?
Yes. Buy through foreign market.
Okay. If you have zero share investing experience, I will advise you not to do it. Do the Malaysian one first. Right? Reason is we are Malaysian, we are here, so some of the names, when you see the brand, you briefly understand what are they doing, because just now the quadrant, the business, the management, then the financial and the valuation. These are the four aspects that we need to do our study. If we don't do study, we just jump into the bandwagon, it's gonna be quite dangerous. So my advice is, let's do the Malaysian one first. At least you understand the process. The process are the same. Just now, you use a share screener to screen, and then from there you do your research to check the background, whether the dividend yield, the EPS, then the PE ratio. Look at that, not only 1 year, but compare the 10 years and see whether they are considered okay or not for the past 10 years. Only then you place your investment. So if you go foreign country, you can do the same, right? Maybe with internet you can do that, but you need to have the same process lah. The only thing is you may not know some of the person there. Example, if you look at the management, maybe you are not able to collect information about who is behind managing the country, example. Okay, so I will advise you not to jump into it. I know, especially now US is booming. A lot of people coming to tell you, oh, let's go into US share. It's booming, man. It's crazy. It's a rally. I just want you to know one thing. Warren Buffett, in his recent annual AGM, annual general meeting, one thing about his company, the Berkshire, is holding record high cash, because he found that there is no interesting stock to buy at the moment. That's why he has been holding a lot of cash in hand. He cannot find any interesting share to buy now, because in the layman term is he cannot find a cheap stock that he think is worth to buy now. It's kind of expensive. Right? So this you have to read between the lines. So whatever I share this particular model very much is also very much linked to Warren Buffett's philosophy buying value stocks. So yeah, so be careful. Yeah, foreign market is, especially US, is booming now, but don't simply jump into it. Maybe it's too late to jump into it. I cannot tell. I don't have crystal ball. Maybe just begin to rally, then you still can catch the train. It could be you are already at the tail end. You come in now, maybe you're holding quite expensive kind of stock. Then you may lose out later on. But just try. Then build the small portfolio, and from there, play with it, get used to it. The thing is, this exercise is aimed to have you having a better emotion. I use the word handling if market go down, then how? Because you only start with 10,000 with 5 shares example. So you may see, oh, I buy that share and now it dropped, I lost 5%, 10%. So the thing is hold, because fundamental very good, valuation maybe not so good, but I think it's to hold lah, right? So just now the 5 scenario, so use that criteria to help you to decide to hold or to sell, right? So you need to withstand that kind of pressure when market not good and the stock you're holding suddenly depreciate in terms of the share price. But it's a good company. You quickly sell or you hold. But I remember look say valuation very good, should be hold what? Hold lor. So this is how you train yourself the emotion to handle any market correction or market downturn, because you know that when investing in this dividend is for long term. These are good company. Maybe you work out some more, it's time to buy some more, example, right? Because it's cheaper. PE ratio is very cheap now. I may be able to buy cheaper and more shares. So there's something that you need to train yourself up. I hope all of us here are able to grab this point. The exercise here to begin with a small portfolio is to train yourself up before you expand it to a bigger portfolio and before you begin to expand to overseas. All right. So that will be the sharing for this month. Anyone got any more questions to ask? So far so good. All right. Of course, I'm recording this, so I will just resend to all of you, including those absentees, so that you can read it again or watch it again. Yeah, should you need anything, just let me know. So I posted to you already the KLSC screener. Yeah, the Excel file, I have to do something to clean up so that you see. I have to disclaim that it is directly download from the screen KLC screener, so you have to really use it at your own I will use the word own care. I'm not able to tell you that particular Excel will help you to make decisions. You have to really use your own knowledge to understand. So PE ratio is important. Yeah, dividend yield is important, and EPS. Look at the 3 things. Okay. If you guys have no more question, thank you for coming in for this month's monthly coaching. So we shall meet again next month. All right. Bye bye.